before I introduce the panel, I'd like to just thank Brad and Ben and everybody at Primary for putting together a great event today. I think the sessions have been really strong. When I look through the list of attendees and the people that are sitting in the audience, it's also super impressive to see everybody here in New York. There's a lot of people like Jason Del Rey that run their own conferences. Mark Schuster was here somewhere, and they're sitting in the audience. So that's pretty cool, and thanks for putting it together. I'd like to tell you a little bit about our panel, and also today keep in mind that this is the Consumer Day. This topic is being covered in Consumer now. Tomorrow it'll be covered with Enterprise, and we're going to kind of keep New York and Consumer as the focus of the conversation today, although we will go a little bit broader. But I'd like to tell you a little bit about our panelists. We've got Beth Ferreira, who's a managing partner at WME Ventures. She's also one of the most experienced investors and operators in New York at some of the earliest investors and some of the biggest, fastest growing companies in New York. And it's her birthday, so you can buy a drink and have that. Paul Hsiao from Canvas Ventures is next up, and he told me before that he thinks he's the dumb money on the panel, and I think that's Absolutely. Not true at all. I think if you look at some of his investments that he's on, Zola's, he's on the board there, Hsiao's, many others. I think he's being quite coy when he says that, but glad to have him here. Next up, we've got Jeff Richards, who's managing partner at GGV. We've had the pleasure of working with him on a bunch of investments, from Hotel Tonight to Percolate to Box to Square, I believe. And Jeff is also a frequent commentator on CNBC, so I'm really looking for him to bring it to this panel here today. And then we've got Alex Taussig, who's a partner at Lightspeed Ventures, who has been seen recently on Planet of the Apps, if anybody watches. He's another...
Any Apple Music subscribers in the audience?
You have to watch it after if you haven't. So I expect him to bring it as well today. And it was just interesting, he mentioned before that he's been to New York 3 times in the last month or so.
Yeah, that's about right, actually.
Okay, so it's just cool to see a lot of center of gravity, happening here in New York. So I want to kick it off with a little bit of a lightning round from a question that was brought up earlier, and I like it, and I want to hear it from this crowd. I'd like you to quickly go by and give the answer, and maybe like a Twitter-sized answer to what's the biggest investment regret or miss that you've had from a New York-based consumer company? And Beth, we'll start with you.
I'll say Dia. We were there at the Seed.
Tell everybody what that is.
Dia is it's basically Stitch Fix for plus size, based here in New York. 2 great founders. Had nice traction at the Seed. We saw it a little bit late. Got a small allocation and decided it wasn't big enough for us. So the allocation, that is. So we passed, and that was a mistake.
For me, it was probably Glacier. Last year, Nabil at Thrive and Kirsten from Forerunner. We've been really good collaborators on Zola. They're you really ought to look at this thing. And Emily and Henry, who are the CEO and COO, this is probably the first team I've met outside of Adia House. Every time you meet them, 3 times they actually raised the number and beat. And you would think I would actually understand what I was looking at, but I didn't. So I miss Glacier.
I would say, we're as a firm, we invest from early to late, and if you look at a lot of the Series B, C, D investments we make, they were things we passed on early. So we have a lot of pain from early misses. One that we caught, it was more on the enterprise side, but it was Buddy Media. We caught it in the Series C, but I had met Mike in the A and the B, and so that was a frustrating one. I love the company and love the outcome, but it was frustrating to not get in sooner. But fortunately, as an investor, we can always come in later and just pay a higher price.
Back in the day, I remember meeting Matt and Ilya, who would eventually start Blue Apron, and they had this idea called Petri Dish, and they were trying to build a Kickstarter for science experiments, and that was actually the first idea. And I actually kind of liked it. I used to be a physicist before I got into venture, and I was passionate about funding science. And then they decided not to do that, and they decided to do this meal kit thing, and we passed on the meal kit thing, which was a dumb decision.
I'm going to go too. So I was reminded today of how we should have invested in Slice. You might have heard earlier that they were in our office, and we had the opportunity and didn't have the vision to see what it would turn into. I think there were 10 people in the company when they came in, and I think there's now approaching 300 in the company now. It's so you got that one there, Jeff. And I'll give it another one that was one of yours too, which is Jet. And I don't believe we actually had a chance to look at Jet, and I'll be honest and say, like, I was pretty skeptical of it the whole way through until the fantastic exit. But if we go way back when I started First Round about 11 years ago, we had a chance to invest in this crazy thing called 1-800-Diapers. And we just thought, how could that ever be a big business? And missed that opportunity. So the topic of, like, today is consumer, tomorrow's enterprise. And I just, so this conference has about a 50-50 split, at least in terms of time. I'm curious, again, if we just go down the panel, maybe we start with you, Alex. Like, in your firms, traditionally, how much what's been the split in your firm, consumer enterprise, and how's that changed in the last year or so?
It's been pretty idiosyncratic for Lightspeed because we haven't had that many consumer investors historically. Lightspeed started about 20 years ago, and it was started by 4 infrastructure investors. We had made a few health-related consumer investments. We invested in Blue Nile, but it wasn't really a dedicated practice of the firm until Jeremy Liu joined in 2006. And for a while, it was really mostly him. About a year and a half, 2 years ago, I joined the firm. Aaron Battalion, my partner, joined. My partner, Nikki Quinn, joined. And so within a year, we went from having 1 partner doing consumer to 4, and that's really accelerated a lot of it. But even despite that, I'd say if you looked at just number, it's probably about a third of our portfolio is consumer, strictly consumer, and we mean by that is e-commerce, marketplace, digital media, consumer services. And that's probably going to increase because we have more partners doing that stuff, and it just takes more shots on goal, frankly, to have a meaningful outcome in consumer. So we sort of expect our failure rate to be a little bit higher than our enterprise practice, and so that the volume needs to be a bit higher.
Yeah, so our firm is half the firm is in China and half is in the US. And we manage, our current fund is about 1.2 billion. So in China, we're pretty much 100% consumer. There's not a huge enterprise opportunity. There's a big opportunity, but not a big market in China. In the US, it's probably 50-50 consumer and enterprise, and probably has been over time. I think what's interesting, I was just kind of listening to what Alex said, if I look back at the GGV's been around since 2000, if you look at the 17 years, the 5 biggest outcomes have all been consumer. So, we had a company in China called Qunar. We had Alibaba Group, which is the biggest return our fund's ever had. We have Wish, we have Hsiao, we had Square, we had Pandora. So a lot of the big drivers of the fund returns have been consumer. We tend to get a higher batting average in enterprise. And so I think that it does dictate a little bit of the way we look at investing in consumer-oriented companies and kind of the lens of how big an outcome can we really drive here, because we're going to have, we do end up with a lot of losses. We end up with more losses in consumer, but bigger outcomes on the ones that win.
Yeah, I mean, for us, we came together in 2013. We managed about $475 million, now 3 partners. I think before we came together, most of us were more consumer. My partner Rebecca Lynn was on the board of Lending Club. Gary Little was on the board of Evernote, and sort of me being privileged to be involved with House. I think Fund 1, we're about 20% consumer. I think Fund 2 now, it looks to be about, it's still early, it looks to be about 30 to 40.
So we're a little bit different than the rest of the firms here. We're 2.5 years old, and half of our capital comes from WMIMG, which is the largest talent agency in the world. So we have about 90% of our company is in the consumer space, mainly because that's where we can deliver the most value from the platform. But we do occasionally do an investment in the enterprise side.
Yeah, so just some data from First Round that we were looking through recently. We've always done consumer and enterprise, but in our earliest funds and earliest days, there was probably a majority of consumer. And as we look at our most recent fund, it's actually flipped to a majority of enterprise. And we think it also reflects, certainly at least in the New York ecosystem, the kinds of companies that are being built. So Jeff touched on it a little bit, but I'd love to hear others comment on like like enterprise businesses tend to have limits at what they exit at versus consumer can be, much higher upside. Like how do you reconcile that or deal with that fact?
I mean, in our firm, we believe that you can have these. It's possible to create $10 billion enterprise value companies in enterprise, but the number of customers you have to address, the sales and marketing challenges of getting to those customers, the ACV that needs to be supported, all that math needs to actually work out, and there's just very few companies that can do it. Either they sell something that's a high ACV through a direct sales process, and they get to a certain point, or they sell something that's very cheap to a lot of people, but it takes a lot longer. It's sort of interesting if you look at App Dynamics and you look at New Relic, two different companies in the same space with very different business models, but it's still hard to get to that $10 billion outcome. The way our enterprise practice appears is that it's a lower beta, but a more consistent return, expecting to get several billion-dollar outcomes. Companies like Nutanix and MuleSoft and App Dynamics, and then every now and then we have something like Snapchat come along. And when a company like that comes along, it just dramatically influences the performance of the fund. And so hopefully you can get one of those in every fund, and you only really get that through consumer, and maybe very rarely something like a Shopify, or I think Tableau was worth $10 billion at one point, or a Workday. But it's just so much rarer in enterprise.
So does that turn into different filters or bars that you look at when making an investment decision?
I think for us, we tend to enter at Series A and B. I think it sort of calculates into, depending on the entry post-money, what are the probability you enter in 10x. And I think depending on your enterprise, both sides certainly have those potentials. We see the consumer tend to, when it works, it tends to accelerate much faster. And you really know when the consumer name doesn't work fairly quickly. And I was a partner on the NEA platform for 10 years. You just saw it right away whether the consumer is going to work or not. On the enterprise, there's a formula to it in terms of how you put the sales force to work. And if it doesn't work, you have 2 or 3 tries at it, right? I mean, people sort of talk about Tableau. That was the second investment that I made, with Scott Sandell. That took a long time, right? But you could be patient with it and make the enterprise work. Whereas consumer, it doesn't seem to be as sort of, you don't really have that second shot as much.
It also seems that these big consumer companies, when they get to be that valuable, they get there because they're able to sustain that value. There's network effects that allow them to sustain that value. There's a lot of SaaS companies that have great products, great go-to-market, great unit economics, but ultimately they compete with like 4 other players, and they all have to battle it out in the market. We see that dynamic in enterprise. A lot of times it's actually hard to see in that middle phase who's going to be the winner. Whereas a lot of times in consumer, you get out in front, and those network effects start working, and you can still screw it up, but they will suck the majority of the market into your business.
It's more winners take all.
I actually think we're going to see a blurring of the line a little bit in some cases on consumer and enterprise. I would actually use Slice as an example. So if you think about what Alir and his team are doing, I don't want to put words in your mouth, but they are creating a marketplace for consumers to order pizza through a mobile application that is then connected into Slice OS, which is a software platform that they're giving to the merchants to use to operate their business. So it's, if you go back, I've been in Silicon Valley for a while, 10 years ago, 15 years ago, the mantra was you can't sell to SMB. It'll never work, you can't monetize, you can't build a sales force, just don't do it. And now if you look at the companies that have been built in the last 10 years on the back of selling to SMB, you've got Square, $10 billion company, Shopify, $10 billion company, you've got Wix, $6 billion company, you've got GoDaddy, which is largely driven by SMB. So a bunch of like $5 to $15 billion companies that have monetized the SMB space, and I think we're going to see more companies like Slice that figure out how to create something that's of value to the consumer, has a mobile application / web front end, probably a marketplace dynamic, so aggregating demand, and then pulling together the supply and creating a ton of value for the supply. And if you look at a lot of consumer applications, when they come into a market like food, they go after the customer, the consumer, and say, let's aggregate demand. I think one of the things that's interesting about Slice, Alira is really partnering with the merchant. So it's a very merchant-centric approach. How do we get somebody to be part of the Slice family and create something of value for that merchant so that I believe the majority of the customers today on Slice all came from merchants, right? The merchants, the marketing budget at Slice is tiny. For a $150 million run rate business, GMV run rate business, the marketing and acquisition cost has been almost zero because the merchants are doing all the acquisition. So we're looking for more things like that, where people are sort of combining a value proposition for the consumer, but tied into a software/enterprise model, probably largely focused on SMB.
So the topic is moving goalposts of Series A and B, and there was a recent post done by Hsiao that we spoke about in preparation, where he was talking about the companies that are getting funded in their Series A and B and those that aren't, and he proposed that the ones that are getting done are having one of the following three conditions being met. He said either it's an elite executive team, that's what he calls the team test, or it's a highly demonstrable metrics, the numbers are there, the metrics test, or there's a real detailed roadmap and a vision of how they're going to get from here to there, and he calls that the communication test, being able to articulate that. I was wondering, like, does that resonate? Does that fit with what your companies are seeing in the market?
It resonates, but I think that it's not one of the three. I think you need at least two of the three, and maybe even all three of them, particularly now when the bar for Series A continues to be risen, or continues to rise. I think the biggest impediment is telling that story and telling how that story, how the company is going to be a multi-billion-dollar business and what's going to take to get from point A to point B, and that takes the team, it takes the metrics, the proof points, and then it also takes like what's the milestones.
Yeah, no, I certainly resonate with that. I think being a good storyteller with two of the three metrics certainly seem to be at least a minimum bar. I mean, the other thing we've seen when we've done two investments recently, the matching with the right investor interest really matters here. Having your board and having your existing shareholders to do research with you to figure out who are your prospect, maybe it's Jeff, maybe it's others, that truly understand your space and are interested. A lot of times we see entrepreneurs just go cold pitch, and that usually hasn't been as bad idea.
Yeah, there's also, I love Samil's frameworks. He distills things very well. But there's like this one other factor maybe that there's a company that you met 6 months ago. It wasn't quite ready for the A. You stayed in touch. You meet every couple months. You see that what they're saying they're going to do, they're actually doing. And they get to a point where it's still a little early for an A, but you just have so much confidence that it's working that you decide to go in and make a preemptive offer. And I've seen that more and more now because people have these seed extensions now and insiders are putting a little bit more money in to get these companies a little bit farther. What that does is it sets them up to do something preemptive before they're ready for the A. But this only works if you're actually really on top of the company. And it doesn't really scale because our calendars are all very filled. But there's a couple of businesses that I'm tracking in that mode.
Maybe the flip side, maybe I'll ask Jeff if you've got any thoughts on like any examples or kinds of things you've seen go wrong, like when a company runs into a problem. What are you seeing?
Well, first of all, I think fundraising at the Series A and B is a lot harder than it's made out to be. I mean, I think it's sort of painted as this glorious, chariots of fire. You run down the runway and they hand you a medal and everything's wonderful. It's really freaking hard. And I think for every company you read about that raises 10 or 15 or $20 million, there's literally hundreds that are out there struggling to try and get something done. So that's just my first comment. I think and Samil wrote that post because he's seeing so many of these companies that he has seed funded think that they would just snap their fingers and raise an A, and it's not happening. I would say, a couple things. One, I mean, to Alex's point, if you have the time, and I started two companies. I raised a lot of money for those two companies, so I know how hard it is. So this comes from like me making my own mistakes and fucking up, but also what I see now as an investor. one of the things that a lot of entrepreneurs don't think about is the time that it takes to fundraise. And so they run into this situation where they're sort of like, oh, I'm going to raise money when I have 6 months of cash left, but then their marketing guy wants to take up the burn so they can juice their numbers and go into the fundraise with strong numbers. And all of a sudden they have 90 days of cash and they're going back to their existing investors and saying, hey, how about a seed extension? And it just starts to look like a mess. And the people on the other side of the table can kind of see that and sense that you don't really have a great grasp of how you're running your company and that you're sort of running it with an eye towards raising money as opposed to building a big company. So my general advice to folks is don't, run a real business and run a business that you feel like is going to be successful and there will be plenty of money available to you. We see a lot of folks that try and time their fundraisers around certain growth spurts and, that's why you end up with a lot of these seed extensions, because then the A doesn't happen or the B doesn't happen and they're going back to the well asking for additional capital because they just misjudged the timing. And I think money came so easily in 2014 and 2015 that we now have this hangover where, honestly, I think most venture capitalists are being much more conservative today than they were 2 years ago, and entrepreneurs haven't yet adjusted to that. So my main piece of advice is give yourself the runway, give yourself the time, run a real business, get to know a few folks that might be good investors for you 6 to 9 months in advance of raising capital, and give yourself the time to do it right.
That's great. Yeah, also made me think of just some stats I've seen recently from places like Mattermark and CB Insights that show if you take everyone that raises a seed round, what % of them matriculate into successfully raising a Series A? And that number overall market-wide is somewhere like in the 40 to 48%, that successfully do a Series A. And about half of those go on to get a Series B. So you're down into like the 20 to 25% range that make it from seed there.
I think there's also a lack of internalization around the raising the seed and what you need to do to raise the A. And so, understanding what the investor on the other side is looking for, and we're looking for value and what you've been able to create, as well as
I think I would say the other thing that we've seen a shifting is that say 5 to 10 years ago, the Series A was really idea, right? You're trying to get a product market fit. With the C and institutional C and post C have gone to a point where it's 3 to 5 million capital raised. By the time they get in front of the investors for Series A, you're really looking for the old Series B traction to raise, and most of Series A are now approaching 10 million for Series A, and Series B are really, we're looking at 2, both in the 20 to 25 million. So really, I think the industry as a whole, we collectively have shifted a bit as well. So that's some of probably the moving goalposts that we're seeing.
Yeah, I was going to ask on that point, and that's what we're seeing in the Series A's and B's as they're shifting. Even in the seed round where we play primarily, we've seen round sizes from like 2011 to today have basically doubled. They used to be about 1.2 million. They're now like 2.5 million. And like the overlap in the whole shift, it's really kind of a continuum. So I'm just like, does that make like the traditional Series A thinking and, is that less relevant now, or how do we adjust for that?
I'm not really sure how to answer that question. I think, so we're predominantly Series A, Series B investors, and we're not just looking for an interesting concept, but we're looking for evidence that, in the consumer space at least I can speak for, that the entrepreneur has a critical insight into consumer behavior, and that they've somehow been able to prove that they've accessed that insight. And it's really great when that insight is not broadly shared by a lot of other people. So whether that's, when Jeremy found Evan Spiegel at the Snapchat seed round, it was a seed, but it was very clear that it was working. You could see that through the engagement and the growth. And it was working in a way that was not well understood, where most people said, oh, that's a bunch of dick pics. Well, actually, 70, 80% of the users are women, so it's probably not all dick pics. So you basically have to look at the data objectively and say, does that correspond to what the entrepreneur is telling me their intuition is? And that fit can happen at any stage. So I'm not really sure what the difference between a seed and an A and a B is. We ask the same question at every stage.
I do think, though, that there is a unmistakable expectation on the investor side of progress versus capital raised. And so, you know, I was with an entrepreneur the other day that raised, an experienced entrepreneur, but raised $5 million in his seed round a year ago. And I'm talking with him, he says, yeah, I want to come out and raise a Series A. And I said, well, I don't think you've accomplished that much with the $5 million you raised. And it's going to be a challenge for you. And I don't know that everybody goes into that kind of perpetual seed raising mode, understanding that you are increasing the expectations of what you'll accomplish in that time frame. There are certain entrepreneurs who are repeat founders or in a huge market or just has a ton of tailwind and it may not matter. But there definitely is, you know, when an investor asks, how much have you raised so far? There's definitely a little bit of a calculation in their mind that's saying, well, how much have they actually accomplished with the amount of money they've raised to date? And if you're accomplishing a lot, it's a really easy conversation. But if you've raised a ton of money and kept raising and not accomplished a lot, it can make it challenging.
I think that's something that's changed in the last 3 years. I think we saw those big rounds 3 years ago, and that there wasn't as much scrutiny in the Series A. You raised $3 million versus $1 million, and where did you get to? I think also, you know, from the standpoint of moving goalposts, you hear a lot about, you know, oh, I invest in late seed. I mean, what does that mean? But, you know, overall, I think there's two factors. One, there's a lot of money coming into seed, but two, it's never been easier to create a company. So, you know, between, you know, human capital management, you know, democratization of acquiring customers, you know, Facebook or whatever, you know, it's just been a lot easier. So companies are coming into the seed more advanced than they were 5 years ago or even 10 years ago.
And at least in the e-commerce space, we spend a lot of time, and I know Paul does as well. I mean, what success looks like has just ratcheted up. With very few resources, raising a few $1 million, we've seen a number of companies fly out of the gate doing $1 million a month sales, do $30, $40 million in sales their first year, sometimes even more. That's incredible. And so when you say, so with the seed round for those companies often looks like there's like a pre-launch seed, and then within the first month they launch, they see that that's working. It's like people trying to put in a lot of money. So it's very sector specific, I think. And the ones I spend the most time in, over the years, I've just seen the bar get higher and higher.
That's true.
I want to let the audience ask any questions they've got. I don't know if you have any right now. Get them in mind, and we'll bring the mic around so we can get yours answered. We talked a little bit about some sectors, and let's talk about some that are specific or endemic to New York. Think of things like e-commerce, media, direct-to-consumer brands. There's a big concentration of those, but I would also say that those are not the most in favor categories right now. In fact, like if you just look at e-commerce and just take, you know, Walmart, with 3 recent acquisitions, you know, from Jet and ModCloth and Bonobos, those were done at 3 very different multiples and states of offense or defense. Like, how do you all think about the state of like those sectors given, you know, questionable exits right now?
I mean, I think the exits are actually as good as they've ever been in e-commerce, right? You have Jet at $3 billion, you have Chewy at 2 or 3. I can't remember. There's 3. You know, Stitch Fix is a company that's talked about some of their numbers. You have Paul and I are involved with this company called Zola, which is doing quite well. I mean, you actually have seen more success in the non-digitally native brands. Interestingly, like the one that people thought was be really tough to compete with Amazon in, which is being an e-retailer, turns out to have been the one with the biggest outcomes so far. But there's also a few of these digital brands that are growing so fast. So I'm quite optimistic, actually. And I think then you look on the retailer side, there's never been more blood in the water for the department store business. For some of the large big box retailers, they need to figure out their business model going forward. Walmart's been very aggressive here. You've seen Target come into Casper in a big way after a rumored acquisition. So you're going to start to see more of these guys who have lots of cash, big market caps, figuring out what their digital play is, and they're going to,
So you're not worried at all? You think times are good?
I'm always a little worried. But I think it's better than it was 5 years ago. I mean, 5 years ago, my partners would ask me, when was the last time an e-commerce company was bought? And everyone would say diapers.com for 1 time's revenue.
Yeah,
we have a few more comps now.
I agree with that. We're very bullish on e-commerce. 3 of the most valuable private companies in America right now are in e-commerce. You've got Wish, $8 billion, Fanatics, $4.5 billion, Hsiao, $4.5 billion. So I think part of the reason you're not hearing more about it is none of those three companies do any media or press, right? They keep a very low profile. Wish and House and Fanatics all keep a very low profile, so they're not out there talking about their companies and their valuations. But those are three of the most valuable private companies in America right now. And so, and they've all been, those are all created in the last 5 to 7 years. So I think there's a secret underlying healthiness to that market. And then if you look at a company like Shopify, which is in the e-commerce space, now valued at $10 or $11 billion, there's a couple other players in that space, Magento and BigCommerce. So, and then you look at what Square's done. I just think we're still in the early days of what that space is going to look like. Amazon is really hard to compete with, but Peter at Wish talks about Wish as Amazon subprime, right? Because the average Prime customer makes $125,000 a year. The average American only makes $42,000. So there's a huge swath of America that's not on Amazon Prime that is ripe for opportunity. And whether they're subscribing to Stitch Fix or buying on Wish or looking at furniture on House, there's a lot of little pockets of opportunity that haven't been exploited yet.
I agree.
I think also investors today in the consumer space have a different set of criteria. And so the companies that might have a lackluster exit right now probably wouldn't get funded today. So from the standpoint of really understanding unit economics, what it takes to scale, and what technology can really do in the retail space, I think are things that we, as an industry, understand a lot better today.
But I think, Chris, partly what you might be also referring to is, as compared to the enterprise space, you could have a product, you could have certain level of early traction, and you have a large set of buyers from Cisco and across that will pay $150 to $300. I think from the e-commerce side, the names that we mentioned, I'm involved with a few, are really large companies. So basically on the consumer side, we're gunning for the large outcomes, right? These are IPO companies, or these are names that the SoftBank Vision Fund will be interested to put $10 billion to work for 18%, and no comment on that, I'm sure, Chris. So I think on the smaller outcomes seems to be harder, because if you look at the retailers and the department stores, they don't have as much cash or market cap to buy these things. So in terms of exit on the lower end, it's much harder as compared to enterprise side. But certainly we're seeing large consumer names, sort of market cap getting created.
By the way, I also should mention Peloton, New York company, $billion company that's absolutely, I hate the word crushing it, but they are crushing it. In a category that nobody thought was even, who would have thought there was an opportunity in exercise bikes, right? And John and his team have created this amazing brand and this amazing company. So I just think we're in the first or second inning of a huge amount of opportunity in and around e-commerce.
I agree. I would add Peloton to another one of our misses, but I'm a happy customer at least. And I love the idea. I love the idea of Amazon subprime. That's such a great angle. Did we have any questions? Yes, we do. Jason with the mic already.
Questions. I spoke to Andy Dunn recently from Bonobos and asked him about what advice he would have to consumer product entrepreneurs raising money today. And he obviously raised well over $100 million. And he essentially said, if you're raising more than $25 to $50 million total and you're the one actually making and selling products, like, you should be worried. So I was curious for your take on that, just in terms of amount of capital raised. And the second question, talked with some investors recently in 9 or 10-year-old e-commerce brands that would thought by now they'd have much more, the acquirer pool would be much bigger than it has been, mainly from traditional retailers. And so I'm curious, beyond Walmart and PetSmart, whether you think we're going to see a lot of people get aggressive.
So we take the first question. Every time you raise capital, you're closing doors. So, an M&A opportunity or partnership opportunity is, so I would say that understanding how to be cash efficient and what $1 coming in the door means for a dollar, or dollar coming in the door is coming out the door is really, really important.
Yeah, I think, Jason, on the acquire side, certainly, the Twitch team has done a really good job as the exit to Amazon. It really comes back to which special demographics or distribution channel that you've gone to. I think to your point about the traditional retailers, I think they're playing defense right now, so it's a little bit different. But we certainly have seen the international players from Alibaba to Tencent. We've seen some European players very active in the market with the M&A team looking. So I think over the next 12 to 18 months, you'll see more larger transactions perhaps get announced. So I think perhaps not the US traditional retailers, even though they're looking heavily, but I think you're seeing a lot more international players coming in as well.
I wrote a blog post back last August, and I counted, I think, at the time, there were 31 companies in the Fortune 500 in the consumer products or retail space with about $133 billion of cash. So 2.4 per company. That's just cash. So excluding the market cap, companies like Coca-Cola, Procter & Gamble, Pepsi, Walmart, UPS, Costco, Disney, Fox, like if you take media and commerce and all these things that are blending together, there's a lot of cash sitting around. And in a low interest rate environment, there's not a heck of a lot to do with it. So I think it's more of a low-end disruption kind of, Clay Christensen dilemma these guys face, where they're going to be disrupting their own business model by doing these deals, and it takes someone like a visionary CEO to really go sponsor it. And this is what Walmart's done. They don't do these deals because they don't not do these deals because they're dumb. They don't do them because it's not good for the bottom line in the short term. And that's why I don't think you've seen them all. But at some point, the straw is going to break the camel's back.
I'd add two things on your second question. The Jet team inside of Walmart is kicking ass. Like, I have a friend who just went to work there, and they're doing wonderful things with very little involvement from Bentonville, which is kind of unique. And so I think as that model takes hold and those numbers get out, you'll see other retailers have envy of what they've done. The second thing is the Amazon Whole Foods deal happened, 5 months ago? I don't think most legacy retailers were taking all of this seriously until then. And so now you've got 4 or 5 months, they've had a board meeting or two, they probably hired McKinsey to go do some analysis, how fucked are we? And so you're going to start to see that kick in. I would bet you'll see several M&A deals this quarter, and you'll start to see more next year, because that really was the big trigger. Until then, there wasn't really anything defining where a board could say to the management team, because these companies are still throwing off cash, they still look reasonably healthy, they just don't see that they're about to fall off a cliff, because an entire younger generation is not buying in their stores, they're buying online on Amazon or from Wish or House or wherever. And so I think that Amazon Whole Foods was a big milestone, and we'll look back and say that triggered, 6, 12, 18 months later, triggered a whole bunch of deals. I just don't think they've happened yet.
I agree. I was going to say that if you didn't, I think that was a big shoe dropping in the industry and a bit that flipped, where on one hand you could sort of wait and wonder what might affect you versus like now it's in your face. Like I love like the day after they were acquired, they had Amazon drop-off boxes sitting inside of Whole Foods, and so I think that will play out. And the other thing, just to the first point of Andy Dunn talking about how much to raise, I would also bring up the point of what kind of money to raise, and just I think venture debt has a great place and can be useful in the right ways and the right amounts, but it can also be an anchor and can be a significant problem when companies run into issues. I don't know if anybody has any experience or other thoughts on that, but or maybe I'll ask it the other way. How do you think about the appropriate use of venture debt? Because that's often done in combination with Series A's and B's.
So I think for real working capital needs, like there's definitely a place, but I think that venture debt is pretty easy to get right now, particularly in conjunction with a Series A or B, and it almost feels like additional equity, and the concept of needing to pay that back or servicing that debt is not something that is really internalized, both from the company and sometimes the board as well. And so like ultimately that money needs to get paid back, and if you're not going to get to profitability or have enough cash flow to actually do that, it can be a real problem.
Yeah, I mean, I think in its design it makes sense. We just see people, at least the folks we've worked with, it's a false sense of security. And we, with SVB and a few others we work very closely with, under the right circumstances is fine. Most of the time we really recommend our teams that seriously don't consider.
Other questions? Ben?
What's great about the panel up there is that you guys run different sized funds, and I think, Jeff, when you talked about some regrets or the companies you passed on, you say, well, we got it in a later round. Based on that, are you trying, I mean, you guys have been really active in New York. Are you now kind of pushing and being more aggressive on early rounds because GGV runs a much bigger fund than, let's say, Paul or Beth? I'd love to get your perspective on how
Well,
you guys...
that was meant as a comment as a bad thing, like we should have been in earlier.
Sure. Yeah. So are you changing that and you're now being more aggressive
So
early?
70% of what we do is Series A and B. And we've made, I mean, just with respect to New York, we've made 15 investments in New York in the last 24 months. So we've been really active. We're big believers in New York. We think there's a DNA here that we don't find in Silicon Valley. And we plan to continue that. It wouldn't shock me if we make 15 more in the next 2 years. But yeah, I mean, all of us want to get into companies early. If you miss it early, I think the thing that we figured out, which a lot of other funds have figured out, is if you miss it early, you can still capture a tremendous amount of value on the upside. And my best analogy there is GGV actually, Fund 1 of GGV had bought shares in Alibaba Group at 200 pre when it was a $10 million company, sold some of those shares to Silver Lake and General Atlantic at like, I don't know, 15 or $20 billion valuation, would look like unbelievable return at the time. They then made 15x from there. So there's a lot of money to be made, even if you catch a company in a Series B, C, or D, if you have an exceptional company like a Snapchat or a Facebook or an Alibaba or something that's really going to go on to create uber massive value. I think we, along with others, have gotten religion around we can invest later and still do very well in those companies.
Yeah, I mean, our new set of funds is 1.2 billion, and we don't think of ourselves as late-stage investors. I mean, 85% of what we do is A or seed. But that being said, it's nice when, you know, we didn't get a chance to look at the round that Paul did at Zola, but we were very happy to come in, and because we think it's one of those companies that could be really category defining. And that's one of the nice things about being in a larger platform, I think, is that you have the ability to do that. So, but our involvement in the New York ecosystem is also quite early. You know, we funded John Steinberg at Cheddar when it was just him. And, you know, so we really do consider ourselves to be early investors despite being large.
I see the clock blinking. I'll let the organizers say if we want to kill it or if there's any other questions, we might be able to answer one or two.
Great.
I think people want to drink, and we're glad to give it to you. Thanks very much,
Great.
everyone.
Thank you, guys.